And from red tape to red ink, at least that's what fund manager Roger Montgomery seems to be warning about down the track. Roger, welcome back.
Thank you, Ticky. Nice to be here.
Now, this week we hear that super funds have had their best returns in 16 years, median return of 15.6%. And at the same time, you're writing a piece, I gather, called Super Investors Get Ready to Take Another Bath.
That's exactly right. And in fact, just when superannuation accounts have some semblance of sort of rational returns, or they appear to have regained the losses from the global financial crisis, it appears they're about to take another bath. And that's for a number of reasons. Firstly, the Australian economy does not justify higher share prices. We're not going to see strong earnings growth in aggregate from Australian companies. Secondly, China is deteriorating rapidly, and while many people point to its 7.5% growth rate, the reality is that growth rate could drop to as low as 4% or even lower if in fact China doesn't transition well from its export-led and investment-intensive economic growth to consumption growth. And I think it's absurd to think that it's going to maintain a 7% growth rate as it tries to achieve that. Corporate capital expenditure, fixed asset investment in China is now 80% of GDP, and 2 years ago it was 60% of GDP. So it's now a higher proportion of a lower rate of growth, which means the rest of the economy has fallen off the cliff and the government is taking up the reins.
Now, the other area I wanted to talk about was, the Cassandra's talking about this potential bubble in the US equity markets. I noticed Phoenix Equities, Graham Summers' thoughts on US equities. He says it will have not gone unnoticed that IBM, Intel, eBay, Google, Microsoft, BlackBerry all missed their revenue estimates, and that US GDP is turning sharply down.
And Ticky, that's my third reason for being very cautious about investing in Australian shares at the moment. And not only that, McDonald's has only grown its revenue 1%. In fact, if you look at the US second quarter earnings, 107 companies have reported so far. But what's really interesting is if you take out the finance sector and the finance companies that have reported, there's no growth in revenue, and there's been negative growth, about 4.1% negative growth to earnings. So while it's only one quarter, and one quarter doesn't make a lifetime of investing, the reality is that there appears to be a trend forming, and it looks like shares have gone well ahead of themselves. And it's because of this artifice of money printing.
Now, attached to the US performance, presumably that is an element as to why the gold price has taken off recently.
Yes, it is. And it's really interesting. In fact, we're asking the question internally at the moment about whether or not gold stocks look cheap. And one of the things that we've noticed is that there's a very good correlation between share price performance and the margin of gold companies, their gross margin in Australian dollar terms. And so we're measuring that correlation through regression analysis, and we've discovered that there appears to be some value in gold stocks at the moment, despite I guess, aggregate sentiment being negative towards that sector.
Can I ask you to pick up on the story on Whitehaven that we had earlier, the Whitehaven hoaxer? Roger, what do you make of this? Do you think this is ASIC using a hammer to crack a nut, given that this is an individual who obviously has a green cause facing potentially up to 10 years, or do you side with ASIC on the issue of market integrity and the importance of it?
I think there's a balancing act that needs to be made here, and that is ASIC is right to pursue anybody that jeopardises the credibility, the transparency and the reliability of the Australian market. They're right to pursue that. But whether or not a 10-year jail sentence in this particular case is warranted, I'm not sure, and I'd leave that for the judge.
All right, well, we'll see how they go with those allegations against Newcrest. Roger Montgomery, thank you very much for joining us.
It's a pleasure.